Thanks for jumping back to Lamb's Cryptoverse. Today we're going to do something different. What I'm going to do is focus on reading and actually telling you these bullet point ideas I've got on market timing. Then at another time, maybe a few days from now, a week, who knows, I'm going to give you a longer video on market timing, and I'll show you some charts that back up what I'm saying. So let's get started. The story goes for this video is that the common knowledge is that market timing does not work. Everyone says that. All the smartest minds in finance, they're all bombarding us with data sets saying that market timing does not work. But they only give us, despite all this, despite all the people speaking and all the academics, remember these are academics too, University of Chicago, Sloan School of Management, Harvard Business School. Despite that, there is only circumstantial and anecdotal evidence that market timing doesn't work. They don't give us what's called empirical evidence. I think you hear more about that in statistics or when you're studying drug development. The word empirical, meaning what is the exact performance of professional market timers? That's the key point here. But I'm also going to give you the opposite view. I'm going to give you the devil's advocate view, which is, as you know, or I believe, and you probably know and believe too, active investing doesn't work too well either. It depends. It depends what time period you're looking at. But overall, active investors tend to underperform the market, being S&P 500, for example. And in certain years, 2/3 of active investors underperform. So if that's true, it follows that market timers, being that they are by definition active investors, right? Active professionals, they will not outperform the market. Well, here's the deal. I think we need to do better measurements of who exactly are these market timers, instead of looking at individual and / retail investors and saying that they're just the herd. They have no idea what they're doing. So financial investors, advisors like CFPs, certified financial planners. Oh, by the way, I should have said this earlier. This is not financial advice. I am here to entertain you. Okay, let's get going. Let's continue. So these financial advisors, CFPs, recommend staying in the market 100% of the time. As a matter of fact, they have this saying. It's a tee-off of the truism about market timing. The truism is that it's not about market timing. It's time in the market. You see what they did? They reversed the words. So basically they're saying don't think, don't allocate, don't in terms of tactical allocation, even strategic allocation, just put all your money in the market and let it be. And there's studies that say even putting a whole lump sum of your money at the beginning of the year, for example, outperforms all this thinking and allocating and fancy strategic tactical allocations. But then they tell you something else. They tell you that the PE, all these smart financial advisors and analysts are always telling you, for years they were telling us, until now they were saying the PE is too damn high, it's too high, it's a bubble. Well, you can't say one thing and then say the other thing. Because if you're saying the PE is too high, you're saying that you should sell stocks. But that means you don't believe you believe in market timing. And then you say the earnings yield is too low. I'm not sure if you all know what the earnings yield is. I'll tell you an easy layman's way. It's basically comparing the yield of, they flipped the P ratio, but the easiest way is just comparing the yield of treasuries, like the 10-year treasury yield of 4%, whatever, with the dividend yield. Let's look at that way. There's another way of looking at earnings yield, but basically when treasury rates are high, the PE ratio should be lower because the two are competing with each other. So the other thing is they recommend dollar cost averaging. Again, if you're saying that market timing doesn't work, why are you recommending dollar cost averaging? Because in a way, that is market timing. You may not call it market timing, but it is. It is. Okay, stop. I'm getting a little carried away here. So basically, what I want to say is I'm a firm market timer. It took me years to admit that and years to have the confidence and the guts to say that because, number one, I never had confidence in anything. And even though I spent years analyzing financial markets, reading all these books, they're right there on the shelf. I have a whole shelf of all these books I read on the markets. But despite that, I went to school and I even have certifications. So I have all this academics that's saying market timing doesn't work. So it's hard to go against that, especially when these people are so much smarter than you. But finally, after many years, I finally discovered myself that market timing works. But on the certain events, I'm going to get that to you later. I'm just looking at my notes here. So I think, and this is like something else I want to talk about. The markets are said to be efficient, by the way, and that means that you can't time them, that they're always representing all the information at a specific point in time. But I want to use efficient in another way. I think we should work efficiently. By that I mean we shouldn't waste time stock picking. Stock picking is only important during certain times in the market, number one. And number two, it's only worth something, a grain of salt, when you're looking at certain generational type companies like Amazon, your FANGs and Tesla, for example. But even those, as you know, lately are not working, right? FANG dropped 20% one day. Amazon was down after hours 20% one day. Then I think closed down 8%. And Alphabet got hit. And Netflix got hit. So it's been a really tough market. But my point is, don't waste time on individual names. That's low odds. What you should do is spend time on themes, theme investing. We don't hear enough of that. We hear about Kathy Wood all the time. Now people are making fun of her. But she's one good, important aspect of theme investing. So work on looking at CRISPR and DNA sequencing, mRNA technology like Moderna, fintech like Square, PayPal, AI and robotics, and the world's going electric, sun power, things like that, windmills, the IoT, Internet of Things, and of course Web3/blockchain. That's what you should spend time on. And even then, stocks, I should say, not market timing, stock selection doesn't work unless the market's in an uptrend. When it's in a downtrend, all the correlations of stocks, and assets that are supposed to be uncorrelated, they move to one. So why bother? So what I want to say is market timing does work, but only works best under regime changes. So what's a regime? A regime, especially a regime change, is when you have like rising interest rates or high inflation or war or COVID-19, when you have a specific event and the market acts a certain way. That's what we have now. We have a regime change that started in March, between January and March, or January and February of 2022, basically the first quarter of 2022, the Fed started tightening liquidity. So that was a regime change. And that's when market timing does work. And later on, I'm going to show you another video with some charts and my sentiment indicator that shows you proof that market timing does work. Well, thank you all for listening, and please like us and come back.